not much has really changed over the last 3 months or so. And the primary drivers of the Fed's decision making haven't really changed all that much either. So if you look at the unemployment rate, it's ticked down a little bit, but the participation rate is still high, which means that there's still a lot of long-term unemployed people out there looking for jobs. So the reasons for the tapering to be staved off, to be put off, are still there. And then, of course, we had all the shenanigans in Washington a few days ago, which inevitably would have been concerning the Fed in terms of the impact on consumer and business confidence. So absolutely right, the likelihood of tapering has been pushed back a little bit. So if the most likely scenario is the orderly exit, what we do expect over the next number of years, it could be 3 years, it could be 4 years, is a steepening of the yield curve, so that you would see the long end of the yield curve go from the 2.6% that we're currently seeing for 10-year treasuries up to that 4 to 5% range, which is more normal, and then seeing the short-term end as well moving up to perhaps that 2 to 3% range, which again would be more normal. And in that kind of environment, certainly our portfolio and the way we're thinking about things, we should do quite well. We have some specific exposures in our portfolio to do well in that environment. So way back in September of last year, we purchased 2 custody banks, State Street and Bank of New York Mellon, that will benefit in a normalising interest rate, normalising capital markets environment, and our holdings in Wells Fargo and US Bancorp with huge zero-cost interest deposit bases will also do very well in a normalising interest rate environment.